Hello students, today we're going to do a quick revision of both IHT and VAT. Starting off with IHT first, I'll do a quick recap of the topic. IHT or inheritance tax is a direct tax which is levied on the transfer of wealth between individuals and trust. Now, here it becomes taxable on the death of the donor. So if the death of the donor happens within 7 years of the transfer of the wealth, there is a direct tax called as inheritance tax. It is a capital tax which is levied on an individual's accumulated wealth, and it becomes taxable at the time of person's death. So when you transfer wealth to another individual, when you transfer an asset to another individual, it comes under CGT as a taxable transfer. Also, it comes under IHT as a chargeable transfer only if the donor dies within 7 years of making the transfer. It's a progressive tax. That means as the wealth increases, so does the tax, and it is redistributive in nature. Then transfer of value. Coming to the transfer of value, when shares are gifted between individuals, we need to calculate the transfer of value, which is the value of the estate before the transfer less value of the estate after the transfer, which gives you the transfer of value. Now, when you do the calculation, this applies for shares, okay, gift of shares among individuals. When you calculate the value of the estate before the transfer, the percentage has to be taken by the total number of shares in the company. The value of estate after the gift percentage is also considered with the total number of shares in the company. There are some IHT planning advices that you can give your client. For example, it is always better to give early lifetime gifts. So preferably PETs or potentially exempt transfers. Why so? Because PET at the time of transfer is exempt. And if the donor survives 7 years, it is also exempt from additional liability. So if you make early lifetime PETs, you can save tax at the time of transfer as well as within after 7 years of transfer as well. Now, if you want to make CLT, that also you can make as early CLTs with a maximum amount of your NRB, which is 3,25,000 with a 7-year gap. So there are many advantages there. Early CLT means you can avoid additional liability. By the amount of NRB means you can utilize your NRB and the tax will be at 0%. 7-year gap means you can avoid the 7-year accumulation there. Now, the thing about CLT is at the time of transfer, anyway, there will be a tax liability computation. But if the amount is exactly same as NRB, you can tax at 0%. If the donor survives 7 years, you can avoid additional liability. So it's always better to give early CLTs. Another advice is to transfer the wealth to your spouse or your civil partners rather than your children or grandchildren, because transfer between spouses are exempt in IHT. Then, transfers during the lifetime, that is other than the death estate, transfers during the lifetime also benefits from annual exemption of 3,000 for the current year and brought forward 3,000 from the previous year. Skipping a generation. So instead of transferring the wealth to your immediate descendants or to your immediate children, you can transfer it directly to your grandchildren. So many students have a misconception that the overall IHT liability can be reduced. Yes, but ultimately the grandparent has to suffer some IHT liability. They can skip it in 2 generations. So instead of the grandfather giving it to the children and then children handing over to their children or the grandchildren of the grandfather, you can directly make the transfer to the grandchildren. So 1 generation in the family can skip the tax liability. What are the advantages of lifetime transfers? Early PLTs, so that if the donor survives 7 years, it will be exempt. So when you make lifetime transfers, and that is PET, the donor will survive. If the donor survives 7 years, it will be exempt. Annual exemptions can be availed. There are exempt lifetime transfers like marriage gift, normal expenditures out of income, etc. Then CLTs, even if it is taxable at the time of transfer, it's a small percentage of 25 or 20. Now, it's always better to transfer assets whose values will increase eventually in future as a lifetime gift. Because when you make the lifetime transfer, always the tax liability computation will be calculated on the original value, not on the market value. But when you do the calculation in death estate, they take the market value of that asset at the time of the death. Then you have lifetime transfers broadly classified into exempt transfers, which is small gift exemption. The gift per donee per tax year should not exceed $250,000, £250. Marriage gift exemption, where the gift given by parents per parent, they can claim an exemption of up to £5,000. Grandparents and groom together, they can claim groom or bride can claim an exemption of up to £2,500. And relatives can claim an exemption of up to £1,000 per person. Normal expenditure out of income. In order to claim an exemption, it has to be of habitual nature. It should not affect the standard of living of the donor. And spouse exemption. So any transfer between spouses that during the lifetime or after the death is exempt. PETs are transfers made to individuals like son or daughter at the time of at lifetime. Now, at the time of transfer, it is exempt. If the donor survives 7 years, it is again exempt. If the donor died within 7 years, it becomes taxable at 40%. CLTs are gifts made to trust. At the time of transfer, it is taxable. The donor can pay the tax. Default, it is down to 25% and you have to gross up. Donee pay taxes at 20%. If the donor survives 7 years, it is exempt. If the donor died within 7 years, there is an additional IHT liability of 40%. Now coming to the additional liability computation. When you calculate the additional liability computation, we have to first see whether the person survived 7 years from giving the gift. If they survive 7 years, you don't have to do rest of the calculation. Second thing is 7-year accumulation. The previous 7 years of their lifetime, did they make use of their NRB, which is 3,25,000? Third thing to consider is it a CLT? Was the tax already paid? You can deduct it at the time of additional liability computation. Fourth thing is taper relief. That means the person should survive a minimum of 3 years, but less than 7 years. So you can claim tax reductions of 20, 40, 60, and 80% depending on the range. 3 to 4 is a 20% reduction, 4 to 5 is a 40%, 5 to 6 is a 60%, and 6 to 7 is a 80% reduction in tax. Then there is death estate. The death estate includes all the assets and liabilities of an individual at the time of their death. You can just simply add together their asset values, except when you take a pension fund, which is not withdrawn, it is an exempt item in IHT. Rest of all the assets, be it car, be it ISA investments, those are exempt in CGT, are taxable under IHT. It is taxed at 40%. There is no annual exemption. NRB is applicable. It is paid by the legal representatives. So the due date of payment and the responsibility of payment aspect is covered in assessment for individual. Please watch that video. That is chapter 22. There is no taper relief available in death estate, and transfer between spouses in death estate is also exempt. Who suffers the IHT liability on the death estate? It is the residuary legatee, or the person who is finally going to inherit the property. They are going to suffer the tax on IHT. The format, you have to take the residential property, you have to deduct any mortgage. Now the mortgage has to be either interest only or repayment mortgage. Endowment mortgage is to be ignored. All the other assets have to be added. Just make sure that pension fund is exempt. Gambling debt is non-deductible. Verbal promise is non-deductible. Rest of all the items, including the funeral expenses, are deductible. You get your chargeable estate after making transfer to the spouse. Then you deduct NRB and RNRB. So NRB, again, you have to apply the 7-year accumulation. RNRB is only applicable if there is a residential property in your death estate and it is inherited by your direct descendant. So RNRB is lower of £170,000 and your residential property minus interest only mortgage. You get your taxable estate. Now, another thing to keep in mind is sometimes a question will ask you, what is the amount inherited by the residuary legatee? That means the end inheritant of the property, what is the amount they receive? Or what is the wealth they will receive? So you take the total death estate value, any transfers given to your spouse or the brother or sister, and all the IHT liabilities have to be deducted. The remaining amount is to be inherited by the residuary legatee. Then, Coming to NRV and RNRV, unused NRVs and RNRVs can be transferred to the surviving spouse, legal representative. So let's say a situation where A and B are married. A dies, he has unused NRV and RNRV. B is the surviving partner. So the unused NRVs and RNRVs of the deceased spouse can be claimed by the legal representative of the surviving spouse. And it can only be used once the surviving spouse also dies. So when the death estate calculation for the surviving spouse is done, the legal representative of the surviving spouse can claim the NRV and RNRV of the first deceased spouse. So when you do the transferring of NRV and RNRV, first you need to calculate what is the percentage of unused NRV and RNRV made by the first spouse. And that percentage has to be transferred to the surviving spouse. So let's right away go to the question practice. So we'll start with the MCQs first. So Ben died on 14th February 2024. When his wife Bella died on 13th September 2010, 35% of her nil rate band of 325,000 was used. That means 65% of Bella's NRBs and RNRBs were unused. It can be claimed by the legal representative of Ben and can be used after the death of Ben. So they did not have any children. How much nil rate band may be claimed by Ben's legal representative on his death? When such a question is set, you have to take the unused percentage. Okay. So as you do the calculation, first thing to do is to calculate the unused percentage of Bella's nil rate band. The question said she used 35% during her lifetime. That means 100 minus 35 is her unused NRB. So her NRB during her time was 3,25,000, of which 35% was used, 65% was remaining. Now she can transfer that 65% to Ben. So when you transfer it to Ben, you have to keep in mind, you have to take the NRB of Ben, which is 3,25,000 into 65%. That is 325,000 into 65% can be transferred to Ben. To this, you have to add the NRB of Ben as well. So the overall NRB that Ben can utilize is 536,250. So it is 536,250. Next one. On 14 July 2022, Ray made a gift of 5,000 to his daughter, Wanda. On 17th October 2023, he made another gift of 6,700 to her. What is the value of PET to Wanda made on 17th October 2023? So, in order to decide on the chargeable PET amount, we have to adjust for annual exemption as well. And when you take the annual exemption, you can take the current year annual exemption of 3,000 and any unused brought forward annual exemption of the previous period as well. So that means on 14 July 2022, that is when first transfer happened. That is on 14 July 2022. 14 July 2022 is basically 22-23 tax year. So they have made a transfer of 5,000. So that 5,000 means 22-23 AE was utilized, entire 3,000 was utilized, and they were also able to utilize 21-22 AE as well of 2,000. So basically that particular transfer did not result in a chargeable amount. But the problem was all the AE of 22-23 was utilized. Okay, so full AE of 22-23 was utilized. Now, let's take the next transfer, which happened on 17th October 2023. So the transfer value was 6,700. This is AE of 23-24, can be fully utilized, which is 3,000. But you cannot brought forward any unused AE from the previous year because it was already utilized in the previous year transaction. That means you are left with 3,700 as your amount. So that is your chargeable PET. On 6th November 2023, Andre made a gift to a trust which resulted in a lifetime inheritance liability of 39,450. So this is the tax which is payable on CLT at the time of transfer, which is 39,450. On what date is this liability due and who is responsible for paying the IHT? So keep in mind, for CLT at the time of transfer, donor and the donee can make the tax payment. If the donor pays, it is 25%. If the donee pays, it is 20%. By default, it is the donor, Andre, who is supposed to make the payment. Nothing is mentioned in the question. The liability lies with Andre. Now the payment date. So the payment date is from the transfer date, month end. So you have to take the month end of the transfer date. You have to count 6 months. So that means 6th November, you have to take the month end as 30th November 2023 and count 6 months, which is December, January, February, March, April, and May. So that means the date falls on 31st May 2024, payable by Andre. When you do the date comparison, it is actually later of 30th April after the transfer and 6 months ended after the transfer. Here, 30th April is basically after 30th April is before the 6 month ended. So therefore, I'm going to consider 31st May 2024 as a payment due date. Next case. Chan died on 8th December 2023, having made a lifetime cash gift of 500,000 to a trust on 16th October 2022. So it was a CLT. He paid the inheritance tax. The donor paid the tax at the time of the transfer. Who will be responsible for paying the additional IHT made to the trust, and when will this be due? So the additional liability for IHT is always from the month of the death, month end of the death to 6 months, and it will be payable by, in the case of trust, it will be payable by the trustee. So in this situation, you have to take the month end of death, which is 31st of December, and count 6 months. So January, February, March, April, May, and June. By 30th June 2024, the trustee will have to make the payment of the additional liability. Indicate whether each of the following obligations are deducted or not deducted when calculating the value of a death estate. Outstanding repayment mortgage is deducted. Now keep in mind, if it's endowment mortgage, you will ignore it. Funeral expenses is deducted. Outstanding interest-only mortgage is also deducted. You will not deduct endowment mortgage. Verbal promise, it is not deducted. Gambling debts from unlicensed gambling, that is also not deducted. Next one. Benjamin died on 30th November 2023, leaving an estate valued at 890,000. Inheritance tax 276,000 was paid in respect of the estate. He has left 260,000 to his wife, a specific legacy to his brother, and the residue of the estate to his grandchildren. What is the amount of inheritance received by the Benjamin's grandchildren? That is the residuary legatee, people who are ultimately going to inherit the property. So what is the amount they will receive? Which is equal to, from the chargeable estate or from the wealth, a transfer has to be made to the spouse. So the chargeable estate is 890,000. From 890,000, a deduction has to be, or a transfer has to be made to the spouse. So the spouse transfer here is 260,000. There is also a transfer to brother, which is equal to 120,000. And any tax due, so which is equal to 276,000. So basically, the value of estate is 234,000. Heng is a wealthy 45-year-old who would like to reduce the potential IHT liability on her estate when she dies. So they are asking you, identify by clicking on the relevant boxes whether each of the following actions will be effective or not in achieving Heng's aim of reducing IHT. So here Heng is a person who wishes to reduce his IHT liability. So the following advices are given. You have to check whether it is effective or not. First one is changing terms of her will. So the residue of the estate will go to her children rather than grandchildren. That is skipping a generation. Now, skipping a generation is beneficial for the intermediary generation. That means the children of Heng, because they will avoid IHT liability. But Heng will ultimately have to suffer it. There is no choice for him. He will have to transfer it to someone. And in that transferring process, he will incur IHT liability. So that is not effective for Heng, but that is effective for the children of Heng. Making lifetime gifts to trust up to the value of nil rate every 7 years, that is very effective. You can make the transfer to your trust up to 3,25,000 with a 7-year gap. Changing the terms of will so the residue of the estate goes to her husband rather than children. Yes, so you can claim spouse exemption. making lifetime gifts to the grandchildren early in life. Now, to a large extent, that is effective because if you are able to survive the 7 year, it is a case of PET, and also you can avoid additional IHT liability as well. Next, we'll do a question, which is a multitask question. And I hope you're aware of the fact that IHT is a area which is tested in your section B multitask questions. So we're going to do the question, Sam. Identify whether the following statements are correct or not. So irrespective of reading the scenario, you can give the answer to this. Sam's cash ISA is exempt from IHT, so will not form part of his death estate for IHT purpose. Just keep in mind, things which are exempt in income tax and CGTs are not necessarily exempt in IHT. That means ISAs are taxable, premium bonds are taxable, NSI savings certificates are taxable. So this statement is incorrect. If Sam invests in a stock and shares in ISA, it will be exempt from IHT. Again, the answer is no. The only thing that is exempt in IHT is unwithdrawn pension funds. So both the statements are wrong. What will be the lifetime inheritance tax that will be payable in respect of Sam's gift of 450,000 to a trust if Sam pays the tax arising from the gift? So this is CLT. They're asking you the tax at the time of the transfer if the donor pays. So that is 25%. So Sam, aged 76, has already invested 4,000 in cash ISAs. He now wants to invest in stock and shares as he has heard these are tax efficient. But in IHT, these are not exempt. These are taxable in your death estate. On 20th December 2022, he made a cash gift of 200,000 to his daughter. So that is 20 to 23 tax year. He is now going to make a cash gift of 450,000 to a trust on 20th February 2024, which is 23-24 tax year. So when you make the computation for this, for the 22-23 tax year, there was a transfer amount of 2 lakh. From that 2 lakh, AE of 22-23 will be deducted. The entire 3,000 will be deducted. And the previous year AE will also be deducted 3,000. So basically, there is no unused AE for 22-23 tax year. Now, when you do the computation for 23-24, which is 4,50,000, they're expecting to make a gift of 4,50,000. On a chronological order, this is the first one. Less, there is an AE for 23-24, which is 3,000. And the 22-23 AE is not utilized, which is 447,000. So you cannot take the 22-23 because that was already finished. So this is your taxable amount. When you calculate the IHT liability, another thing to keep in mind is there is no indication that the person died. Okay. So that means this 200,000 transfer to the daughter is not yet taxable and you have not utilized NRV so far. That means the entire NRB, 3,25,000 is available for this transfer, 0%, which is 0. And the remaining amount, which is 447,000 minus 325,000 will be taxable at 25% since donor paid. So that is equal to this amount minus 3,25,000 into 25%. So the total tax liability is equal to 3,500. Next one. What amount of marriage exemption will be available against the wedding gift to Sam's granddaughter? So any gift made to granddaughter up to 2,500 can be claimed as exempt. So Sam is planning to make a gift of 10,000 to his granddaughter on her wedding day. Up to 2,500 will be exempt. So just keep in mind, parents, it is 5,000. Grandparents and spouse, grandparents or the bride or groom up to 2,500. Any other friends, relatives fall under 1,000. So this is 2,500. If Sam were to die in the near future, how much of the nil rate will be used by the gift to his daughter? So the first gift to his daughter, they're asking you how much of nil rate will be used. So when the question says, remember the chargeable amount is 194,000. So from the 2 lakh, you have to deduct the annual exemption for 22-23 and 21-22. So your taxable amount is basically, or your chargeable amount is 194,000. That means you will use a maximum NRB of 194,000. If Sam were to die on 30th June 2028, which of the following statements are correct? The rate of inheritance tax applied to the lifetime gift as a result of death will be 40%, which is correct because on death, the additional liability will be 40%. So option A, the rate of inheritance tax applied to lifetime gift as a result of death will be 20. No, the additional liability is always at 40%. Inheritance tax liability can be reduced by 20% taper relief. No, because taper relief is available if the person survives a minimum of 3 years. So he is dying on 30th June 2028. And let's say the gifts are made in 2020. 30th February 2024. So he has to survive a minimum of 3 years. So the tax liability will be a reduction of 40%. Option A and D. Next one is what amount of PET of the house to fill in 2007? On 23rd August 2007, P made a gift of house valued 325,000 to his son. This was a wedding gift when Phil got married. So since it is a wedding gift, up to 5,000 can be claimed as a deduction. And you can also claim current year and previous year AE as well. So that means from the value of the house, which is 3,20,000, 3,20,000, you can claim marriage exemption of up to 5,000. You can also claim up to 3,000 current year AE and previous year AE as well. So that brings us to 3,09,000. What amount of IST will be payable in respect of 2018 transfer as a result of parents' death? So on 6th September 2018, P transferred further property to Phil. The value of the potentially exempt transfer after all available exemptions were 380,000. So you will have to calculate the transfer value, which is 380,000. From that 380,000, this 380,000 is after deducting all available exemptions. That means the AE for the current year and previous year are already utilized. So you can directly move into your IST liability computation. In the previous 7 years, that is, you can take from 6th September 2011 to 6th September 2018. There were no NRB utilization. So 3,25,000 will be taxed at 0%, and the remaining out of the 3,80,000, 3,25,000 remaining will be taxed at. So this is 40% additional liability computation. We need to check whether he survived. Whether he is eligible for taper relief or not. So there is a taper relief available. So you have to check. September to 18 to 19, 19 to 20, 20 to 21. So he has survived 3 years, 21 to 22, 22 to 23, and 23 to 24. So that is like 4 to 5 years. So there is a reduction of 60%. It's a 5 to 6 year situation. So there is a 60% reduction. That means the taxable amount is equal to, this will be treated as a deduction, 8,800. What amount of IST will be payable in respect of the estate as a result of his death? So they're asking you the IST liability on the death estate. P died at 76, at which his estate consisting of cash, chattels, and investment was valued at 880,000. Under the terms of his will, P divided his estate equally between wife and son. That means out of the 880, 440 is for his wife, which is exempt. Remaining 440 is for her son. P had not made any gifts during the lifetime except the 2 gifts to Phil. So they are asking you, what is the IST liability on the death estate? So first we have to calculate the taxable estate, which is the entire estate value of 8,80,000. From that 8,80,000, you're going to make a transfer to spouse, which is half of the property, 440,000. From this, you have to make a deduction of your NRB. Now, coming to the NRB part, You've already utilized your NRV for the transfer of house to fill in 2018. The next transfer is happening in 2024 within 7 years. That means there is no NRV available. 0. So your taxable amount is equal to 440,000, for which the IHT liability is 440,000 into 40%. 176,000. On the occasion of his wedding, Phil also received the following gift. Which of these gifts will be fully exempt in IHT? 4,000 from his grandmother? No, because only up to 2,500 can be exempt for grandparents. 2,000 from his fiance? Yes, up to 2,500 from the fiance is acceptable. 2,000 from his fiance's father? Yes, that is also acceptable up to 5,000. 2,000 from his brother? No, only 1,000 is exempt from other relatives. So the answer is 2 and 3. What is the latest date by which the IHT liability in respect of the estate will be due for payment, and who is responsible for the payment? Keep in mind, from the month end of death, that is 30th March is the date of death. 30th March. You have to take the month end. So the death date is 20th March. So you have to take the month end. Month end is equal to 31st of March 2024, and you have to count 6 months from here. April, May, June, July, August, and September, which is 30th of September 2024. The tax becomes due from the month end to the 6 months, which is 30th September 2024, and it is paid by the personal representative of the deceased. Next is ACCA. How will the 21-22 and 22-23 AE be applied to these transfers? So on 13th April 2022, which is 22-23 tax year, ACCA made a cash gift of 32,000 to her husband. So that is 22-23 tax year. It's a cash gift of 32,000. So she will use the current year AE, which is 22-23, which is 3,000. She'll also use the previous year 21-22 AE, which is equal to another 3,000. So that is equal to 26,000. There. On 2nd May 2022, ACCA made cash gift to her 3 niece. The first niece was given 100, the second niece was given 200, and the third niece was given 400. Again, this is happening in the same tax year 22-23. So there is a gift of 100. So that entire 100 can be set up with your the cash gift made by ACCA to her husband, 32,000, is exempt in IHT. So basically, there is no requirement for any calculation because there is spouse exemption. So there is cash gift to the three nieces, which is happening in 22-23 tax year, starting off with the cash gift of 100. You can utilize your 22-23 AE, which is another 100. 60. There is another gift of 200. Again, you can utilize your current year 22-23 AE of 200. And is 0. There is another cash gift of 400 to the third niece. There's a cash gift of 400. You can again use the remaining AE of 22-23 tax year, that is 400. 0. So what is the remaining AE of 22-23 tax year? Out of the 3,000, 100, 200, and 400 was already utilized. Which is 2,300. This can be utilized for 23-24 tax year. So that means the transfer on this 100 will fall under small gift exemption. So you can skip a calculation. This 200 will also fall into the small gift exemption. Technically means out of this 3,000 annual exemption, you have only utilized 400, which takes you to 3,000 minus 400, 2,600 unused AE for 22-23. Then there is a gift of shares of 6,500. So from the 6,500, you can deduct your current year 2,600 AE and your previous year 3,000 AE, which takes you to the your remaining chargeable amount as 900. So from your option, 400 is set off against the gift to niece because 100 is exempt, 200 is also an exempt transfer, and gift to spouse is also exempt. So 400 is used against her niece, and 5,600, that is this 2,600 plus 3,000, 5,600 is used against her daughter's share gift. So the answer is option D. What is the transfer value of gift of shares to Afia's daughter? This is value of the estate before the transfer. We have to take the value of estate before the transfer. So value of the estate before the transfer, we have to take the total number of shares in the company, which is 10,000, of which she has owned 8,000 shares. So basically that is 80% holding in that company. So she has a 80% holding. So her 80% holding is equal to 8,000 shares into, you need to find out what is the market value of 80%, which is 8. Remember, the percentage has to be taken on the basis of total number of shares in the company, which is 8,000 into 8. From this, you have to deduct the value of the estate after transfer. So out of the 8,000 shares, 6,500 was given as gift. So out of the 8,000 shares, 6,500 was given as gift. So you're left with 1,500 shares, which is 15% of the total number of shares in the company. So that is equal to 1,500 into, what is the market value of 15% holding, which is $3. So the answer is 1,500 into 3. This has to be claimed as a deduction. So your amount is 59,500. Now, many students happen to do the calculation as 6,500 represents 65% of the whole day. There is a chance that you can multiply 6,500 into the market value of 65%, which is 7. You will not get the same answer. So please make sure you don't do such a calculation. You'll not be getting the same answer. So here the answer will be 59,500. What amount of lifetime IHT will be payable in respect of lifetime gift to trust on 27 January 2023? So they are asking you for the IHT liability to the trust at the time of transfer. So we have to check whether the donor paid or the donee paid. On 27 January 2023, Afia made a cash gift of 400,000 to a trust. She paid the IHT liability. So first let's calculate the chargeable amount. So the gift value is 400,000. From this 400,000, you can deduct the AE for 23-24 tax year, which is not yet utilized because there are no transactions yet in this tax year. So you can deduct the current year AE. But the previous year AE is already utilized. So there is nothing left in the previous year. So this is your chargeable amount, of which we need to check whether there is any 7-year accumulation applicable. No. That means 3,25,000 will be taxed at 0%. And whatever is remaining, 397,000 minus 325,000. Whatever is remaining will be taxed at 25% because it is donor pay. So that is equal to, this will be 0 and this will be 397,000 minus 325,000 into 25%. This is also 20-23 tax year. This is 20-23 tax year. So there is no AE available because that is already utilized. So that means 400,000 minus 325,000 is 18,750. What amount of ISG will be payable in respect of FES estate? So it's a death estate computation. The value of the estate is 620,000, which is tax year 23-24. She left 150 to her husband, which is exempt. So let's calculate the chargeable value, which is 620,000. That is the total estate value. From that estate, 150,000 is transferred to spouse. Then 40,000 is to her sister and the remaining to her children. So that is all taxable. She has lived in her husband's house, did not own her own main residence. That means there is no R&RB available. So when you do the computation, you have to start off with your chargeable amount. Also keep in mind, there is no NRB because in the 7-year accumulation, you have already utilized your entire NRB in the 20-23 calculation of lifetime CLT liability computation. So there is no NRB available. So this is your taxable estate. So this 4,70,000 will be taxed at 40%, which is 188,000. What will be the due date for the payment of IHT in respect of gift to trust, and who will be responsible for this? So remember, gift to trust At the time of transfer, it is responsibility of FER. And the additional liability computation, it is a responsibility of the trustee to make the payment. So you have to take the transfer date here. So the transfer date of the gift is 27th of January. You have to take the month end, which is 31st January 2023, and count 6 months. February, March, April, May, June, July. So by 31st July 2023, it has to be paid by FER. And the additional liability that is on debt from the month end of debt, that is November end, December, January, February, March, April, May. By 31st May 2024, the trustee will have to pay the additional liability computation. So the answer is option C. At the time of the transfer, FER will make the tax liability payment, that is 6 months from the end of the transfer month. And the additional liability will also be paid by the trustee from the death month end to 6 months. And the last question for IHT is Archibald. And those students who are doing self-study, please keep in mind that question Jasmine is also an adjustment for IHT. Question Ralph and Antoinette is also IHT. So Jasmine, Ralph and Antoinette. Tobias is also a question for IHT. Kendra is also a question for IHT. So I'm just going to discuss one more from here, which is Archibald, which contains transferring of unused NRB and RNRB. What amount of RNRB is available to be used against Archibald's death estate? So Archibald died on 27 March 2024, and the IHT is 723,000 is payable in respect of his chargeable estate. Under the terms of his will, he left the entire estate to his children. So there are two aspects here. One, the descendants of the property. It is inherited by the children, direct descendants, which is the children. Second thing to check is, was there a residential property in the death estate? Yes, there was a residential property. So there is chance for RNRB. So he can claim his 175,000 plus he can claim the RNRB of his spouse. Archibald's wife, Francis, died on 1st September 2008 and only used 20% of her nil rate band. Francis and Archibald jointly owned the residential property. So she was also eligible for RNRB, and she has actually, Francis left the share of residence to the Archibald on death. So when you do the computation for this, you can claim the RNRB of the wife as well as you can claim the RNRB of yourself. But when you take RNRB, it is lower of 175,000 plus you have to add your wife's RNRB 175,000. This 20% used is a nil rate band, not RNRB. So the total value is equal to 175,000 into 2, or the value of the estate is 800,000 minus interest only mortgage. So the interest only mortgage is 240,000. Which is 560,000, whichever is lower. So 350 is lower. What is the amount of nil rate band excluding the RNRB which will be available in respect of his death? So he can claim his NRB along with the 80% of NRB of his wife. So keep in mind, the nil rate band at the time of his wife was 3,12,000, of which 80% was unused. So when you make the transfer, you will not take 80% of 3,12,000. You will take 80% of your NRB, your existing NRB, 3,25,000. So that is equal to 325,000 into 80%. Never take the NRB value of the wife. That value is only used to calculate the percentage of used and unused NRB. Other than that, we will not take it. So the value to transfer is 260,000, to which you're going to add your NRB, the fact that you have not used your NRB throughout the period, 3,25,000, because there was no taxable charge which was under the provision of NRB, because there was no transfers during your lifetime. That means you have 585,000 NRB available for your death estate computation. What is the total amount of deductions which would have been permitted in calculating as chargeable estate for IHT purpose? So keep in mind, you can deduct this 270,000 from your residential property. Legal fees is verbal promise, you cannot deduct it. Gambling, that is unlicensed, so you cannot deduct it. So the only amount you can deduct is the interest-only mortgage of 240,000. Keep in mind, gambling debt is not deductible. You cannot deduct the verbal promise as well. Last one. Select who will be responsible for paying the IHT of 723,000 in respect of the chargeable estate and the due date for the payment of this liability. So who will be payable? Who is responsible for the death estate payment? It is the legal representative of the deceased, and the due date is from the month end of death. That is from 31st March, you have to count 6 months. April, May, June, July, August, September. By 30th September, the payment has to go. Last one. Changing the terms of Archwell's. So, which of the following statements are true? Changing the terms of A's will so that his estate is left to grandchildren rather than children would have saved IHT on his death estate. No. Skipping a generation is beneficial for the intermediary generation, not for the first one. So Archwell will have to suffer IHT no matter what, if the transfer is going to children or grandchildren. But if we transfer directly to the grandchildren, the intermediary generation can skip the tax liability. So that statement is wrong. It would have saved IHT if Archwell had gifted the residential property to his children during his lifetime. The fact that you gift your children the amount during the lifetime means there is a chance that if you die within the 7 years, it becomes taxable and you won't be able to claim the residential nil rate band. But if the transfer is happening, and you are able to survive 7 years, you can skip the tax, which is not necessary. So neither the options are correct. So make sure as part of your revision, you do question Tobias, Ralph and Antoinette, Jasmine, and Kendra.